use of leverage in closed-end funds panel. I'm Peter Gargiulo. I'm a director at Fitch Ratings. Fitch has been sponsoring this panel for quite a while now. I had the privilege of hosting it virtually last year, so it's great to be in person with everybody again. I always hear that this panel is looked forward to. I don't know how much of that is true or how much of that is hot air, but we appreciate that. I will say at the top of this that one of the things that we are planning on doing after this panel, subsequent weeks or months, I don't know what the time frame is yet, but we will be publishing this information so that is available to everyone who attended and the market generally. So without further ado, let me allow my panelists to introduce themselves.
Hi everyone, I'm Steve Johnson. I'm Associate Director at Fitch Ratings. I joined in December, and since then my focus has been closed-end funds.
Hey everyone, I'm Brian Knudsen. I'm VP at SMBC in the Global Financial Institutions Group. So I cover closed-end funds and asset managers, and we lend about $2.7 billion in revolvers, term loans, and liquidity facilities to closed-end funds throughout the space.
Thanks. So without further ado, let's dive into the slides. So Steve, can you kind of describe, so you see a similar format for each slide. Steve did a lot of the work to put these together. So Steve, can you just give an overview of what we're seeing here in this slide?
Yeah, sure. So we're looking at the average year-to-date change in net asset value by sector for a few select sectors. This data was pulled from CEF Connect, which people mentioned before. So we're looking at it's through Q3, so through the end of September 30th. And like we said before, I guess this would be the downside of leverage is when we're in a market like we are right now, these funds are performing quite poorly with the exception of MLPs and commodities. And I think even since in the past 2 weeks, since the OPEC plus oil cuts, I think even MLPs and commodities have come down a little bit. But you can see, outside of commodities, it's been a tough year so far. The best performing industry here is down 13% year to date. But again, we're zoomed in. We're only looking at 9 months of data here, January 1st through September 30th. So again, it's just the downside to leverage in a market like this.
Yeah, so I guess as a role of Fitch Ratings is to assign ratings to the leverage issued by closed-end funds, not the funds themselves. Obviously, the NAV volatility is an important aspect when we're looking at that. Steve, maybe, in relation to Fitch's criteria for rating closed-end fund leverage, could you talk about how Fitch's criteria is positioned to evaluate the leverage in this kind of market environment?
Sure. So our criteria for closed-end fund ratings is, I should start off to say, it's reviewed at least annually to ensure that it maintains its ongoing relevance, especially in markets like this. With that being said, one of the key parts of the criteria is a quantitative factor that we assign discount factors to each portfolio holding within each fund. And we specifically look at the asset quality and the liquidity, especially in volatile markets. So after we assign those discount factors, we look at, okay, if this fund had to sell their assets in order to meet distributions or what have you, what would they be able to get for those assets in distressed markets?
Yeah, and maybe the only thing to add, when we talk about discount factors, you're talking about that liquidation window when the underlying securities need to be sold, and what's the worst price drop in those securities within that liquidation window. On the heels of COVID, this was a big lift in terms of our criteria, recalibrating where we needed to for the volatility we saw there in 2020. Many of our discount factors didn't move relative to the price drops you saw in the global financial crisis, but it's something that we are constantly monitoring. And obviously with the shortened time frame, if it's a slow bleed that you're seeing, I think, arguably here with the Fed kind of incrementally increasing interest rates up and that drop in bond prices or fixed income security prices, you're seeing that effect occur gradually over time instead of in a rush like you saw during COVID, or you saw a lot of that occur during the global financial crisis. So, obviously with the currently evolving market environment and the CPI report this morning, this is all a backdrop that we're constantly making sure that we're up to date on that. But let's stop talking about Fitch because I'm pretty sure no one wants to hear about us. Brian, what kind of closed-end fund leverage does Sumitomo participate in, and to which type of funds?
Yeah, so our primary structures are revolvers and term loans. On our portfolio is skewed more towards high yield and senior loan, but we also lend preferred funds, MLP funds, as well as real asset funds. In terms of that and like how we're looking at things now, I mean, this has been a much more orderly situation than COVID. It's been a clearer picture of what the outcome is and that there's going to be what the issues are. So it's been an orderly deleveraging from the funds that we lend to, and really not material concern for specific sectors across our portfolio. Obviously, we do pay attention closely to asset coverage levels across the entire portfolio and all sectors, but from this point, I would say no material concerns with it for us.
Got it. And I mean, maybe I understand there's no material concerns. You know, I definitely agree with the overall theme that you're describing. But I mean, are there any kind of particular sectors that you're more focused on, given the current environment, or have you changed any kind of aspects to the Sumitomo lending strategy?
I mean, I'd say generally we really haven't changed our approach. We've gone through a couple different stress scenarios with COVID and leading into now with deleveraging, and really the structures that we've seen have worked. We've targeted basically top-tier managers as clients that have a longer-term track record of managing leverage and going through cycles, and that's worked out well for us. The structures themselves are aligned pretty closely with the 1940 Act. And rely a lot on their protections, and that's seemed to work throughout.
And I guess to step back from the 40 Act, right, the kind of protections, the structural features that you see in these funds, there is kind of a dichotomy, I think, in our ratings coverage. Some funds actually include various aspects or structural protections that are included in Fitch's criteria, such as the discount factor framework, in those documentation. So they're actually following the criteria in real time in addition to the 40 Act. Others do not, and then how we view that as a rating agency is some stress testing around the margins when we're maintaining or assigning ratings. So I thought that would just be a good element to tie in here. But let's move on to the next slide. With this slide, this is a common one. I don't think we included this last year, but I think it's really important in this current market environment. Steve, can you explain what we were seeing in this slide?
Yep. So this chart, and I should say this chart, and then all the charts going forward, we pulled the financial data from each fund's SEC reporting. So this is for the first half of 2022, so it's pretty fresh. It's January through June. Some funds, report in January, others report in June, so there is, some difference there. But so what we're looking at is the leverage ratios for 304 U.S. closed-end funds. Each blue dot represents one fund. Leverage ratio just being, total amount of borrowing or leverage divided by the total market value of their assets. And like we mentioned before, I mean, closed-end funds, they utilize leverage to boost returns, but also just to boost their income that investors are looking for. And like we saw in the previous slide, sometimes leverage, there's a downside to it. But so in this chart, you can also see we included different thresholds that, some of them are regulatory. I think all of these are the 1940 Act, but then there's other limits that, funds place upon themselves based on, their investment objectives or their policies, and then also funds rated by credit rating agencies may impose their own limit, or the rating agencies may impose a limit based on the assigned rating.
Yeah, and I guess, one of the unfortunate parts about having a PowerPoint is you can't have the side-by-side. What previous years, I think you can really see a change. But Steve, maybe you could talk a little bit about, how does this year 2022 dispersion compare, to prior iterations of this slide?
Right, so we can start, we have taxable CEFs on the left, and I don't want to say historically, but over the past few years, I mean, they would typically cluster right around 30%. If you think of it as a bell curve, this year, it's, there's fatter tails. We're seeing more funds down around 20%, some even close to 50%. I think there's a few reasons for that. I think, starting with the funds down towards the lower end, that could just be funds, lowering their leverage in light of recent market conditions. Whereas on the flip side, funds that are, pushing up closer to 40%, I think that's, asset values falling faster than funds are able to delever. And then munis, moving over to the muni on the right side, I mean, same kind of trend, not as profound, but those usually cluster around 40%. But again, I mean, you can see there's one fund that's down below 10%. There's a handful in the mid-20s, and in the past we didn't really see that. I mean, it was really profound where it would be right around 40%. And then the same thing, there's some closer to 50. I attribute that to asset values falling faster than funds are able to delever.
Yeah, and I think the theme has already been talked about, but the change in distribution patterns, obviously that is a downstream effect of this, and you saw that happening over the summer, especially around the time that this data was compiled. Brian, I mean, so from your perspective, the funds you lend to, where do they kind of fall on this, or what have you seen in terms of their leverage levels?
Yeah, I mean, as I mentioned before, it's been more orderly than we saw in COVID. A lot of the managers have been proactive in deleveraging along the way. Different managers have different tolerances and target leverage limits, either internally or whether that's specifically set by the credit agreement or by the 1940 Acts they like to adhere to and target. So basically, as asset values were falling, we saw them just reduce leverage gradually in order to maintain those levels.
Thanks for that. And I guess one other follow-up on the kind of the COVID aspect, right? Definitely not as COVID was nowhere near as orderly as this. But I would also want to stress that there were no funds that defaulted on their leverage, right? I mean, and, especially the ones that were rated by Fitch, there was still the structural protections, the features that are included with this kind of leverage, operated as expected. So, I'd make sure I want to bring that point home. Maybe we move on to the next slide here. I guess with this one, this is kind of a time series analysis, but Steve, maybe just talk about kind of the trends that we're seeing here and what this slide is showing.
Yep, so this slide and the next one, we're looking at specific types of leverage used by taxable funds and munis. So this one is for taxable closed-end funds. You can see we have, the total amount of leverage by each half year and the different types of leverage. This one, I think we have 235 funds, 47.3 billion in outstanding leverage. I mean, you can see pretty clearly there's two categories that really dominate, and that's bank debt and repo. A couple interesting points. I mean, you can see the steep drop off from second half of 2019 into the onset of COVID, which, like we said, is a bit less orderly than now. And then, there was some recovery through 2020, 2021, but there was, another small dip. So I think looking at, first half of 2022 versus pre-COVID, second half of 2019, I think it's still down 4% total, but I mean, there were signs of recovery up until recent market volatility.
Yeah, and I mean, so maybe, Brian, from your end, I mean, are you seeing from the closed-end funds any kind of increased appetite for a certain form of leverage, that they're engaging you on?
Yeah, it's one interesting thing I mentioned before. We're usually just in the term loan and revolver space, especially on the taxable side. But one trend that we've seen is some taxable preferred shares being issued, and that's been done in a money market eligible format where a bank provides a letter of credit to support that. Typically, that's only been done on the municipal side in the VRDP structure, but we've seen a few taxable funds actually issue that and access the money market investors as a source of funding. And that's been probably the most interesting development I've seen so far in the leverage space. So.
Yeah, I mean, Stephen, what about from the Fitch perspective? I mean, in terms of, what's kind of driving that? Maybe you could talk about that.
Yeah, so new rule 18F-4, which addresses derivative use by funds, specifically repos and their treatment as far as if they're leverage or derivative and different limits it places on that. So, I mean, it went into effect in August. So, again, this data is only through June. So we haven't really seen too much in the charts specifically or in financial statements. But we have seen a couple funds over the summer that, they reduced the repos and they issued new preferred shares specifically because of that new rule. So, again, it's not reflected in the chart yet, but it is something that we're keeping an eye on through the end of the year. And then moving into 2023, we expect to see, more obvious representation of that in the charts.
All right, and then the compatriot to that slide, I guess, is the kind of the time series analysis for municipals. So maybe you could kind of walk through some of the trends that we're seeing here, Steve.
Yep. So similar to the last slide, this is just for munis. 37.8 billion outstanding as of first half of 2022 across 108 U.S. closed-end funds. For munis, we see three primary sources of leverage, which are TOBs, VRDPs, and VFMTPs. Now, in contrast to the taxable funds, muni leverage is actually up slightly from pre-COVID. There wasn't as much of a profound drop-off. You can see there was a drop-off, but it has recovered. And we are actually sitting with more leverage now in muni closed-end funds as opposed to prior to COVID in second half of 2019.
Yeah, and I guess, Brian, what's so SMBC? It doesn't have a presence in the muni space, or what can you talk about that a little bit?
So we have kind of a niche and kind of more narrow focus in the muni space, and that's historically been related to VRDPs. Just us as a Japanese bank, there's some nuances with the Japanese accounting on how certain structures are treated, and it just impacted the feasibility of us doing it. But where we come in is we will act as a liquidity provider that backstops VRDPs or any money market eligible preferred shares, and that's a business that we're looking to grow. And we've done that with the taxable issuances that we've joined and provided liquidity support over the past few years, and would look to do so going forward.
Yeah, and I guess, one element that we kind of brought up in both of these slides, which is a bit new for the taxables, but were those money market eligible preferred shares. I guess if you're not kind of following the money markets as closely, if you're kind of, with all the market volatility going on, it's hard to be on top of everything, but the backdrop in money market funds is rapidly evolving as well. These funds have been very short coming into the Fed hiking to take advantage of those interest rate hikes and be positioned well to pass through to their fund yields. But the other kind of 800-pound gorilla in the room is money market fund reform. And one of the key things to that, specifically for the municipal space, is the treatment. Some of the proposals that are being put forward, which has been delayed in terms of final rules coming out, was the inclusion of swing pricing for institutional tax-exempt funds. Why does this matter? Why am I talking about it? The swing pricing, without getting into all the mechanics, dramatically changes the feasibility, I think, of money market funds in their current form. If you're being charged a liquidity premium for, to being on a net redemption day, you're basically not getting dollar in, dollar out. As a corporate treasurer or an institutional investor in those types of funds, why would you expose yourself to that? How do you get your board comfortable? So one of the big buyers of these kind of preferred shares are money market funds. So depending upon which direction the SEC goes for Rule 2A7, you could see this landscape, an impact flow through to the closed-end fund leverage and who kind of steps into the void of buying those preferred shares. So it's something that, at Fitch, we're focused on. Oh, go ahead.
So are you saying that the money market funds that own the preferred shares will have to pay less than par marks under certain circumstances? Is that sort of one of the possible implications of one version of the change?
Yeah, these came out of COVID. So one of the things the SEC put forward was swing pricing, something they do in longer-term institutional bond funds in Europe. Essentially, when the fund strikes its NAV, in institutional prime, they say like 3 times a day that could happen. If there's net redemptions in excess of, I think it's about 4%, that means that there has to be a swing pricing and a market factor priced into the redeeming shares. So there's a big administrative burden with that. Managers probably more readily able to do that with some CapEx output. There's intermediaries that would have to be involved, would have to get up to speed as well. So there's a lot more CapEx that would have to go into place to implement swing pricing. But then to your point, if you have to dilute the redeeming share amount by the swing factor or the market risk factor to redeem those shares, you're not getting dollar in, dollar out anymore. So it kind of defeats the purpose of utilizing the money market fund. There's a big blowback from the industry in terms of comments, a lot of pushback on it. It's kind of hard to see where it shakes out. There's rumors, only rumors, that some of the SEC chairs are kind of shifting their stance, but we were expecting final rules to come out, or the proposed rules to come out this October. I think everyone's aware, or if you're not, there were technological issues With the comments, I think about 11 proposals were impacted last Friday. So they extended those comment periods by 14 days, thereby throwing the timetable of final rules coming out at least in the next month, but probably later. So, definitely something we're focused on. And the reason we're focused on it, not only because of closed-end fund leverage, we also rate money market funds. So, but it's always interesting in drawing these connections to realize how this could impact this space, not only just our money market fund ratings.
I guess just one thing I would add on the closed-end fund side, the structures that we've seen over the past few years that have been placed with money market funds, they have a lot of optionality in how they can be placed. So if the demand from money market funds shrinks, they're able to basically put that into a different mode and then place that with a bank or a bond fund investor, or kind of tailor it to whatever that investor's needs are.
It's my job as a rating agency analyst to be gloomy. You're making it sound optimistic. No, yes, but but you'll see that those rate changes occur, right? I mean that might happen in real time, and it all depends on what rule comes out, if it's there, and then the implementation window is expected to be about a year plus, maybe up to 2 years. It really depends. So anyway, big sidebar, but I think it was important to bring up.
One more.
And I guess from Fitch, in terms of municipal leverage, we talked about kind of the preferred shares issuance coming out. Is there anything for taxables anyway? Is there anything that we're seeing in terms of muni leverage?
Right. So munis, whereas taxables, we expect to see a reduction in repos for leverage and replaced with preferred shares due to the 18F4 new rule. For munis, we're expecting similar with reduction in TOBs and those to be replaced by preferred shares. Again, in response to the new 18F-4 rule on derivative use. And again, it's not reflected in the chart because it only went into effect in August and the data is only through June, but it is something that we expect to see going forward.
Yeah. All right. We dwelled on this pretty long, actually. So the next slide. Definitely I think this is another slide we might not have included last time. I think there was more of a time constraint, but definitely interesting. This slide and the next slide are important to have in this market environment. Steve, can you just give an overview of what we're seeing here?
Yeah, so this is this one and the next one again, broke it out. This one is for taxable closed-end funds and their current leverage costs. Now this is looking at specifically January 2019 through June 2022. So again, the more recent rate hikes aren't reflected here. And it feels like a long time ago, but back in 2019, the Fed was, I think interest rates were around 2.5%. And then in response to COVID, they were quickly reduced back down towards zero. And now we're kind of on the upswing again pretty dramatically. So, it's interesting data included in here. So you can see the different borrowing costs. The blue bar represents, the low and the high, and then the yellow diamond represents the average for each specific type of borrowing. And then you can see on the right side, we have it broken down between what's influencing those costs. So you have the term of the issuance, the track record of the manager, the sector and quality of the portfolio, whether it's secured or unsecured, the seniority in the capital structure, prevailing interest rates at the time. So again, in the current market, across the board, we saw borrowing costs were going up for funds. As we look, like I said, the data was pulled for funds that reported January through June. So as we started pulling data for the funds that reported in June, it was very obvious that borrowing costs were getting higher very quickly.
Great. And so I guess getting away from the rating agency again, Brian, do you feel like this slide, kind of reflects the current cost of leverage in the funds that you lend to?
Yeah, taking a look, all of our facilities on this slide would be in the bank debt on the far left. And just given the pace of rate hikes, where the majority of our portfolio would be at or above the high. Most of our facilities are priced at a spread to term SOFR now, since moving over from Libor. And term SOFR going into the year was at 5 basis points. As of yesterday, it was around 330 basis points. So that alone is causing 325 basis points of increased cost on these floating facilities. I guess the one exception that we have is we were able to offer one of our borrowers a fixed term loan last year, which definitely has saved a lot for them, which is a win for us and a win for the client. And I think one more thing to say, just in this environment, in this macro environment, I mean, risk is being repriced across the board by everyone. So I would say it's safe to say that closed-end funds aren't necessarily isolated from that.
Yeah, I guess, I mean, that transition from Libor to term SOFR, I mean, how did that go or going? How would you say, that's been felt through the bank?
Yeah, so that's been an ongoing thing. I mean, as of the end of last year, we weren't able to originate any more LIBOR-based loans. At the time, there was definitely some hesitation with clients to switch over, and borrowers just more the fear of the unknown. But now, I think it's pretty much a non-issue. There's more of a robust market. There's structures and precedent structures that borrowers can look to just gain comfort.
Yeah, I guess, I was at another conference yesterday, and one of the big things that kept coming up, it was more on the portfolio management side, but this is, to put things in perspective, it's the first tightening cycle that we've had without Libor. And what does that mean when you're investing? What does that mean when you're looking at the cost of leverage? These are all unfounded territory that I think we're all working through simultaneously, and just another straw to add to the pile of straw that we're dealing with. So going on to the next slide, this is I think the same thing for munis, but maybe a brief overview here, Steve.
Yeah, so same as last slide. I mean, you can see the blue bars represent high and low, yellow diamonds represent the average. We have different leverage costs for munis here, so VRDPs, tender option bonds, variable and fixed muni term preferreds, MFPs, bank debts, and repos. So some of these are fixed, but bank debt is going to be floating, so you can see, I mean, again, same as the taxable across the board, as we were going through January through June, leverage costs were only going up and up. So, yeah.
Yeah, and I, Steve, I guess in putting the data together, I mean, you're kind of going through all the financials, right? So, what are the typical indices that you see here for these types of leverage?
Right, so I would say, I mean, predominantly the SIFMA Muni Swap Index, and again, that kind of replaced LIBOR. We saw a shift for the funds that, had floating rate leverage. All of those financial statements included a blurb about, the transition from LIBOR to a new floating rate index, and I would say the vast majority was the SIFMA Muni Swap Index.
Yeah. No, maybe it's a more general question, I think, Brian, to you. How in a market environment like this, how do you price different forms of leverage, and kind of the challenges of doing that?
Yeah, I mean, as I mentioned before, I mean, most of our pricing is floating and based off of a short-term index. I mean, so there's, I guess, not too much of an impact there. But from any perspective of a lender, if either someone's cost of funds are going up or if the perception of a borrower's risk is changing, then that'll ultimately get passed along to the end borrower. So that's always a potential for change.
Yeah. And maybe from our perspective, I think right now for Fitch's ratings, the closed-end fund leverage for municipals probably can get to the highest rating category, which would be AA. This is following on the heels of criteria changes post-COVID. But from an underlying security perspective, we heard on the panel earlier, we were speaking about various municipal sectors that are kind of underweight or under pressure, mass transit being one of them, arguably healthcare as well. But by and large, probably the strongest credits out there would be municipals, just given the excess cash that they have post-COVID from all the stimulus they received. A lot of that's still bouncing around in the system. So, definitely, I think relative to maybe some of the taxable or other strategies that we've seen here, that they're the strongest they are right now. I think they're at the peak of their credit quality cycle. But again, I'm also not a muni analyst, so I don't want to get over my skis too much. But maybe we move on to I think this slide is probably the most sought after. So maybe, Steve, maybe you could just walk us through this one as well.
Yeah, so again, we're looking at first half of 2022, just specifically bank financing. So facilities, loan facilities, margin borrowing. And then repos. So, I mean, you can see the major players just looking through those columns. I mean, BNP and State Street for bank facility and loans and margins, and then moving the reverse repos. Again, BNP, Barclays, and RBC are the main players there. And you can see we have the change since the last time we did this, which was June 2021. So year over year.
Yeah, and I guess in terms of ratings conversations or requests from managers, how have you seen these funds kind of changing their bank leverage?
Right. So, I mean, primarily shortening, the agreements that they have, changing from facilities to more term loans. Again, just in light of the environment, I think most people are just trying to, lock in shorter term interest rates, and they don't want to be locked into a floater not knowing how aggressive the Fed is going to be in continuing to hike rates. So definitely shortening the tenor and trying to lock in, as low of rate as they can in the current environment.
And I guess I'll have to, now everyone's seen the slide, I'll probably have to apologize to Brian. Sumitomo is not on this list, but can you talk a little bit about, I guess where Sumitomo would fall relative to peers?
Yeah, I mean, so we started, the business was started in 2013. We've controlled it and grown to about 2.7 billion of financing to where we are today. About 1 billion of that is in liquidity support for various preferred shares and the money markets, and the remainder of that 1.7 is primarily bilateral facilities with some agented facilities. So I mean, I think that should put us around 6 or 7, but there are some nuances with the SEC reporting as well.
Yeah, fortunately we rely on that pretty heavily to do this. So I guess, in the current market environment, do you see, banks becoming, I guess, more or less prevalent in terms of closed-end fund leverage?
I mean, I think generally speaking, kind of our appetite for closed-end fund leverage hasn't declined. I mean, the facilities themselves are very attractive from a risk-return basis. The short tenor, high credit quality, and high utilization from the borrowers. I guess that being said, there is a lot of competition for funding across different banks. I mean, there's a lot of borrowers that need funding and different groups that need funding, so there is high competition for that limited amount. I guess one thing that I would add is I guess it's going to be interesting to see where these repo numbers go on this slide over the coming years.
Mm-hmm. Yeah, and I guess, that the kind of 40 Act catching up to speeding in terms of how they look at repo. I mean, Steve, maybe, can you just talk about how Fitch kind of looks at repo, at least as it has historically? There's not really kind of a big change there, but, when we were assigning ratings.
Do you mean in terms of rule or?
I meant more in terms of, when we calculating the asset coverage with discount factors and what we include in the liability side.
Right. So we do include repos there. We're looking at how much they're borrowing, on the short term for repos and what those costs are. And then, again, it was mentioned before about the structure of the leverage, what is the size of their repo and bank loan in relation to the amount of preferred shares that they have issued. Because, preferred shares, some are more fixed rate, so you have that locked in, whereas repos, it's kind of based on, market rates, prevailing at the time.
Yeah. So, it's definitely something that historically when we've been assigning ratings, we consider the relative repo exposure in a closed-end fund when looking to assign actually the preferred shares rating or whatever we're being requested a rating in terms of fund leverage. One other aspect that was kind of talked about today, and I wanted to kind of bring it up on this panel, was kind of the democratizing of alternative investments in closed-end funds. What does that look like? I guess the hypothetical outgrowth of that is eventually you end up with more exposure, and then how do you put leverage on that? To step back in terms of Fitch's experience in this sector, we rate private equity collateralized fund obligations that started in closed-end funds. In our closed-end fund methodology, that's where we rated the first transaction out of. And looking at those kind of underlying assets to service an obligation with the stated coupon and ultimate maturity, amortization schedule, the whole bit, we were able to do that. Now it kind of resides in its own criteria, and we see that through structured products. But there are there are examples of this democratization throughout the world. One of the things that we do rate, or what we call they're the Astria transactions, they're out of Singapore. The most recent one that we rated had about a 40% LTV, debt LTV. Those are eligible to be purchased by retail investors in Singapore. So, there they got the regulator comfortable that, the structure works, and they've done about 7 iterations of it. So, I don't think it's that far flung that we eventually see that come over to the U.S. Now, depends on what the wrapper is and what that looks like. What we typically see is kind of the SPV, true sale of those LP interests into the SPV to issue the debt. So, I guess, that concludes the prepared presentation. We're a little light on panelists this year. We usually have a fourth, so, try to fill up as much time as you can, but I'm glad to take questions or, what have you.
Your very first chart, slide number 1, showed convertibles having absolutely the worst returns through September. Have any convertible closed-end funds been forced to do better?
I don't believe so. I mean, looking at, the next chart, it showed, the threshold for, taxable funds. Some were, sitting right on those thresholds, but none of them breached, as far as my knowledge.
Yeah, and I guess, we monitor the overall coverage limits and the underlying assets, how they're being classified when applying the discount factors. A lot of these convertible funds that we do have ratings out for, if they haven't delivered, they're still above their minimum asset coverage ratio in terms of our ratings criteria. So I don't think we've actively seen the deleveraging occur, but arguably, yes, as things continue to slide, you'll see that occur. Go ahead.
I'm going to answer Barry's question. I'm aware of one fund that's been forced to do that.
All right. So. Yes.
If I may stay on this, I have a couple of questions. On this chart, would you say that the dots at the top are mostly data points closer to June?
Yes.
And the other question is, most of you monitor asset coverage ratios. Out of curiosity, how frequently do you do that?
So, we do it on at least a monthly. We perform surveillance for the funds that we rate. They send us their portfolio holdings monthly or biweekly, so every other week. So we monitor that on an ongoing basis.
For me? It's whatever stipulated by we are able to request on a more frequent basis, but I would say at least every 2 weeks is the vast majority.
And I guess one of the things I'll add is, in times of severe dislocation like COVID, those can become ad hoc reporting requirements if we're severely concerned that the steepness of the drop in underlying NAV and the ability for these funds to delever or what their action plan is might be in question. We'll have interim conversations with the manager or request more frequent reporting. So, the COVID is a really good case study of this, of that steep decline and our subsequent more iterative reviewing of those asset coverage levels.
Right. It was before I joined Fitch, but I'm pretty sure during COVID, March, April 2020, I'm pretty sure we had ongoing conversations, at least daily, where we were asking for updates from the portfolio managers, and they were sending us their holdings and, telling us what they were doing to be proactive about it.
I guess from a lender's perspective and a borrower's perspective, you want to balance the reporting requirements, because if you build it in as a covenant, a lot of the time someone's certifying that. If you're getting daily asset coverage reporting that's certified, that might be a little too onerous on the fund manager and in terms of operationally, but building rapport with the manager and working with them throughout, if there's times of stress, they're usually, they're responsive and we're able to request that.
All right. If there's no more questions, you're free to go to lunch. Thank you for your attention and appreciate the opportunity.